Hello, my name is Samir and this is my presentation on gold as a commodity. I will first begin by talking about a brief history of gold, gold as an investment, methods of investment, the price of gold, and the future of gold. So here's a brief history. Gold has been widely used throughout the world for monetary exchange. This has been by either issuing or recognizing gold coins or by establishing gold standards. The first gold coins of the Grecian age were discovered in Lydia around 700 BC. The gold was measured in the units of a talent, and an individual talent of gold in this period weighed between 8.42 and 8.75 grams of gold. Gold is mostly traded at 24 karat, the purest form of gold, except in the case of the American gold eagle coin and the British gold sovereign that continue to mint gold at 22 carats. So gold as an investment. Gold is one of the most popular precious metals and is used as an investment and is represented by the ISO code of XAU. Investors generally buy gold as a hedge against economic, political, and social unrest. This includes investment market declines, currency failures, inflations, and even in time of war. So these are the different types of methods of investments. There are many investment vehicles for buying gold. The first one is the most traditional method, which is buying gold bars. In many countries, gold bars can be easily bought and sold at major banks. The bars can be bought at various sizes and carry very low premiums. One of the few risks associated with buying bars consists of forgery, since there are not high standards for the appearance of gold bars. The next method of buying gold is investing in gold coins. Coins are priced by their weight and have an additional premium determined by supply and demand of gold. The gold coin that many of you would be familiar with is the American Gold Eagle, which has been minted since 1986 and is depicted in the lower right-hand corner. The next method of gold investment is in exchange-traded products. This consists of exchange-traded funds, exchange-traded notes, and closed-end funds, which make trading gold similar to buying shares in the stock market. Gold exchange-traded products remove the inconvenience of storing physical gold. While ETPs do seem like they're very simple and convenient means of investments, the most popular ETP, GLD, has been condemned and even been compared with mortgage-backed securities due to its complex structure. The pricing structure for ETPs consists of an annual storage, insurance, and management fee that is received by selling a small amount of gold from each ETP. Over time, the amount of gold in each certificate decreases. The next method of investing in gold are certificates. These avoid all costs and risk associated with transfer and storage of gold. Banks can issue gold certificates, which can be on an allocated or unallocated basis. The first gold certificates were issued in the 17th century in England and the Netherlands, and nearly 200 years later were issued in the U.S. by the U.S. Treasury. Investing in commodity exchanges is the next option for investing in gold. In the U.S., gold futures are primarily traded on the New York Commodities Exchange, the COMEX. Many COMEX holders have experienced problems with this method. Issues range from a delivery of the metal to bars with incorrect serial numbers or wrong weight. If none of these options for investing in gold are interesting enough to you, you can always invest in gold mining companies. If the gold price increases, most likely a gold mining company will be expecting an increase in profits and company worth. In an attempt for mining companies to shield themselves from short-term gold price fluctuations, some gold mining companies will hedge the gold price up to 18 months in advance. This decreases the risk in the event of a price decrease, but also decreases returns when the price of gold increases. This chart depicts the price of gold per ounce for the last 10 years. As you can see, the gold price per ounce has shown a positive trend for growth, peaking at almost $2,000 an ounce in mid-2011. While the increase of gold price seems like a lot, many gold investors claim that with inflation, the increase has not been that much. In 1980, when gold hit the $850 mark, it was worth well over $2,000 in today's terms. Reasons for the overall increase in the price of gold can be attributed to the decrease in value of the US dollar and global interest rate movements. As gold is inversely correlated with global interest rates, with interest rates that are near or at record lows in many countries, the price of gold has risen. So this slide shows the future of gold. With that said, gold has seen a decrease in price since its peak in 2011. Many banks are turning their back on gold. For example, Goldman Sachs has decreased their year-end forecast for gold from $1,610 to $1,545 and has also decreased its 2014 estimate. Wall Street banks are attributing this decrease in the value of gold to an improving U.S. economy. And here's Will to talk about foreign exchange and Japanese yen.
Hello, my name is Will, and I want to talk to you about the history of the Japanese yen and the quick depreciation happening this week and how you might be able to make some money in the future. In 1949, during the trail end of the New Gold Standard era and the beginning of the Bretton Woods era, the yen was pegged at 360 yen to 1 USD. This was led by support of the U.S. to boost economic situation of Japan after the interwar period. This decision ultimately being made at the Bretton Woods Conference held in New Hampshire in July 1944, with the actions of the conference not taking place until December 1948, hence the peg starting technically in 1949. Then in 1971, with the help of this Then in 1971, this low yen value bottlenecked the Japanese economy with too high priced imports and too low priced exports. This situation with U.S. support created one of the main international incentives for floating currencies. The pressure felt. Here is a look at the historical prices of the Japanese yen compared to the U.S. dollar since 1970, or 73 to be exact, whenever floating currencies were adopted by the Japanese government. As you can see, the currency fell drastically in the mid-70s, a couple of years after it was initially being traded during the first half of the 1980s. The yen failed to rise in value even though current account surpluses returned and grew quickly. From 221 yen per dollar in 1981, the average value of the yen actually dropped to 239 yen in 1985. The rise of the current account surpluses generated stronger demand for yen in foreign exchange markets, but this trade-related demand for yen was offset by other factors, i.e. the oil crisis and other such things. A wide differential in interest rates, with United States interest rates much higher than those in Japan, and the continued movements to deregulate the international flow of capital, led to a large net outflow of capital from Japan. This capital flow increased the supply of yen in foreign exchange markets. This kept the yen weak relative to the dollar, as you can see in the graph. It floated around 220 to 250 all the way up until the 1985-86 era. Now, there are two things that really affect currencies in today's standards. It's politics and the current account. I've already discussed the current account. Now a little bit look at the politics. In 1985, after a decade of being a floating currency, still had only grown slightly stronger, hovering in the 250s. Japan's economy was still suffering from too weak of a currency. Then came the Plaza Accord, affirming the dollar was overvalued or too strong compared to many other major currencies, ultimately driving the yen in 1985 at 230 yen per dollar to 128 yen per dollar, doubling in value in just 3 years. As you can see by this chart, there was a drastic change in the price of yen, all because of politics, not because of actual economics. The current account balance is one of the major measures of the nature of the country's foreign trade, the other being net capital outflow. A current account surplus increases a country's net foreign assets by a corresponding amount, and a current account deficit does the reverse. Let's take a look at past trends of current account and see how they apply today. Looking here, there are two graphs, the US in blue and Japan red, of the current accounts as a percentage of GDP. The first graph shows 1991 to 2000. The second graph shows 2005 to 2012. As you can see, Japan's had a current account surplus from 1991 until about 1995 of over 2%. After it went down below 2%, in 1995 to 1997, there was a great rise in currencies. This also happened to be the Asian financial crisis, which didn't help the yen either, leading it to a weaker state, as you can check in the graph before. Looking here at this graph, you can see the peak that happened right after 1997. Now, if you look at the bottom graph, the second graph, it is showing 2005 until present time now, with a similar outlook from 1991 to 1996 in Japan's current account schedule, and a similar outlook except inverse of the United States, where they are actually coming out of a current account deficit. Now, Japan's current account is about to go below that 2% threshold. And when it does, the currency tends to go up. Now let me talk to you about where the yen is today and where it might be next. This week, the yen is approaching the contrarian value of 100 yen per dollar. There was a drastic move Wednesday from 92 to 99 yen per dollar after the Bank of Japan chairman Shinzo Abe announced a 74 billion per month quantitative easing plan. Now, anyone that knows anything about quantitative easing also understands that the U.S. is doing one of $85 billion of purchasing bonds and printing money. Now, these might seem similar in value, except you have to realize that Japan's economy is 1/3 the size of the U.S.'s. So they are essentially printing and buying 3 times more bonds and money than the U.S. is in their current quantitative easing plan. I predict that with a combination of declining current account and the rising government intervention, the yen is to weaken and the sky's the limit. Or maybe just 130 to 150 yen per dollar. Either way, it seems like a good trade in the short to mid-term run.